Good morning.
Good morning, sir.
Good morning.
Good morning.
We have 33 people have joined so far. I think we'll start, otherwise we will not be able to complete the particular module. Um, Today we are going to discuss under your Diploma in Credit Management, Credit Risk Management. Actually, it is part and parcel of credit management, but special attention is given to certain risk factors we are looking for. Uh, First of all, I would like you to know whether you understand the. Let me share the slides first. Yeah. Can someone mute your mic and say whether you can see the slides?
Yes, sir.
All right. Okay. So our subject matter is credit risk management. Credit risk management is, as I told you, it is part of the credit management process. Um, Now we pay special attention to this subject because risk management has become a key driver in banking nowadays, and therefore credit risk is also one of the risks which they identify as the substantial risk for banks, especially the current situation where most of our industries having to face the COVID-19 impact and have our NPAs have gone up. Businesses are not getting their expected income. As a result, banks need to manage credit in a very prudential manner in order to sustain the business of banking. So credit risk management has become a very important area. Under the current context, it's more important because of the situation in the country where the economic turmoil is also not helping the businessmen to perform their businesses at the highest level. So first we'll give a definition to what we are going to. You know what is credit? Credit is you give away money expecting uh, for your borrowers to pay back not only the capital but interest. And also you have to remember, when you give on credit, three aspects are there. You need to recover the capital, you need to recover interest, you also need to recover on time, because if there has been delayed, then the, the expectation of giving credit will be lost. So if you look at risk, risk is the non-receipt or the default by your borrower. So especially when credit comes to its, you expect something then to happen. Your expectation is, when you give credit, as I told you, three things. You need capital, interest to come on time. And if none of them works, then it will be a risk. So management is a process, that you need to plan, organize, and do things. So having identified that risk, that is things what you expect is not happening, is the risk. Risk is something unexpected is happening rather than what you expect things to happen. Now, walking on the road itself a risk. Now you don't expect uh, you to slip and fall or meet with an accident on the road, but you expect to reach a destination. But on the way, if something happens, it's a risk, and so you need to manage your walk in accordingly that you will reach the destination. Similarly, our risk management is that. So to give a definition to risk, it's unexpected variability of asset prices or earnings. Now, when you give credit, uh, it goes as loans and advances by the bank, and it is listed in your balance sheet under your current assets, loans and advances. And the price attached to is your original amount granted. And if that price, original amount is not coming, or if you make an investment and the investment is not coming, then there is a variability in the price. And as a result, you will suffer earnings or the profits. That is what you call risk. Especially at the same time, exposure to uncertainty. Now, say some of the credit what you give, also if the due to non-payment or due to delays, you can you classify them as non-performing. So that kind of exposure, non-performing exposure of the portfolio of non-performing is uncertain to come, and that uncertainty is also risk. In other areas of risk rather than credit, any probability of loss or injury also kind of risk. As I told you about, you're going on the road, something happens, it's a risk. So risk has several definitions. When it comes to credit, we will see. Before that, I would like you to take your attention to some of the type of risks the banks are exposed to. There are this slide is very important for you to understand the meaning of risk, because nowadays banks are actually, rather than doing banking, actually they are managing risk, because they are exposed in so many ways to lose the money what they have invested, or money what the shareholders have invested, or what the money your depositors have paid to the bank. You have used in such a way that due to risk factors, you might lose that money. And if you lose that, it will be a loss situation. So to manage those risks, not to lose that money, you need to know what type of risk banks are faced with. Now, we have these three circles on this slide. The first circle is financial risk. As you know, banks are financial institutions, and major risk of our business is management of finances. So the major risk comes there, and in that there are three parts. What happens is the money what customers paid you, or the shareholders paid, or the debenture holders paid into the bank, you are not just going to keep it. You are actually going to lend them mostly, or invest them. So when you lend, what happens is you are giving credit. So if financial major risk come from the credit risk, and if you are investing, that investment risk comes from the market risk. That means credit risk is, I will explain to you further, but market risk, since you are not going to touch, I will touch here. Market risk is about change in price or in the interest rates on your interest sensitivity assets and liabilities. So what happens is if price of an assets or interest rate change, there could be a loss of profit to the bank. Now I'll take, for example, we'll take your foreign currency portfolio. Now say all the banks have foreign currencies in various banks, either in nostro accounts, or we call it, and those balances, you aggregate them, and now say some of the balances are credit balances, some of the balances are debit balances. So you aggregate them and arrive at a net open position. That means you arrive at the net position, how much whether the bank owe in foreign currency to others, or bank has credit balance with others. So we'll consider that bank has in several currencies, you have credit balance. Now what we do in banks is these balances, we convert them into US dollar at the middle rate, and because that's our major currency of the country, their foreign exchange are concerned. So this US dollar, we again convert at the current rate of exchange to arrive at the value what you're going to put into the your balance sheet. So in your assets, if you have credit balance in currencies, we convert them to dollar. Dollar, we convert them at the prevailing rate of that particular date. And the rupee value you record in your balance sheet under current assets. So that assets is your foreign currency exposure. Now this foreign currency exposure is converted at today's rate. Tomorrow, we'll say today's rate is 203 rupees for a dollar. And tomorrow, this rise to 210. What happens? If you have a credit balance, you convert that dollar amount into 203 yesterday. Today, you are going to make it to 210. So if you have credit balances, your rupee value goes up than yesterday. So the difference we take into profit. What happens if yesterday was 203 and today it comes down to 201? Then you record a lesser value in your balance sheet under current assets where foreign exchange is concerned. And then you have a difference from yesterday to today, minus figure, we call it a foreign exchange loss. Similarly, if you can have debit or credit balance, we call it, if you are debit balance, we call it short net foreign currency exposure. We call it net exposure, so short exposure. If there's a credit balance, we call it a long position. And if you have a long position, if rate goes up, the rupee depreciates and rupee against dollar goes up, bank will make a profit. If it goes down, bank will make a loss. So similarly, we have invested in treasury bills, bonds, we have invested in gold. So these are kind of investments done at certain rate or certain price. And if this price falls, we make a loss. So other financial risk is the market risk due to change in prices. Then we also have to manage liquidity. Whenever we need to, when there's a demand for withdrawal, you need to actually all the liabilities on your balance sheet. Some are on demand, some are payable at a maturity date. So on those days, you need to have in cash or near cash items in order to pay those, make your obligations right. So if you don't have, you will have a liquidity risk. So this financial risk, we mainly touch on credit market and liquidity. And our subject is credit. We are going to extensively discuss on that. Then the other risk is the operational risk. Operational risk is, bank need to run. It doesn't run automatically. Operation risk, if I had to give a definition, operation risk is failure or inadequate losses due to failure or inadequacy of your processes, systems, or people will create losses for the bank. Those are, we call it, operational losses. And operation risk is the other major area, especially now we have major risk because those days we do branch banking, we have opening and closing time. During that time, you are exposed to customers, and your major risk come from external factors like robbery. But nowadays, you are open 24 hours, 364 days with your internet banking open, phone banking open, and so you are subject to a lot of operational matters throughout the year, and risk could occur in any of those areas through the failure of technology or legal action, or if you fail to provide your proper service, your reputation is at risk. So those are kind of linked to your operations. So we need to actually provide better customer convenience. We need to, keep our customers with us. Otherwise, any shortcomings or any complaints will affect our reputation. The other thing is the strategic risk. The strategic risk is something to do with your customers and your competitors. As I said, if banks doesn't have much leeway to play in this area, mainly because all the banks provide similar service. You can brand your product, but it may be similar. Some bank may, for instance, some bank may name their minor savings account like Arunalu, Tikiri or whatever, but it is the same product, but we finally sell. So where strategically we cannot actually outbeat our competitors, but the main factor is to provide the best service, to be in line with market norms, and to make your customers happy, and also win your market share from your um, competitors is the strategies banks need to adapt. On this aspect, actually, banks spend a lot of money in marketing, in advertising, to keep their position or the corporate image intact, so that strategically they are aligned to be ahead of their competitors and to win customers. So those are the three major areas. But bank is a highly regulated business. Therefore, these circles mingle each other, and then there is a hub being created, which I have marked in yellow. That is where your, I would say, godfather or the central bank dominates you, because you are actually subject to compliance risk if you don't obey or adhere to rules and regulations and the directions issued by the regulator, because it's a very important that because of the central bank's regulation, the confidence level of customers are there for us to have their deposits in our banks. So these are the type of risks banks are facing. Every sphere there is a risk. Actually, every department has their own risk types. But our subject is your credit and credit management. So it is come under financial risk, and our subsection is the credit. So from now onwards, we move to the credit risk. Actual credit risk, if I have to give a definition, it is potential for financial loss where customers or counterparty. Now, actually, the term what we use for our customers in credit is a counterparty. We call it, if customers fail to pay, we call it a counterparty risk. So counterparty fails to meet their financial obligations. It's mainly losses associated with counterparty risk of default. So when customers default, either capital or interest or not pay on time, as I said earlier, you will have credit risk. Similarly, as a result of this, what happened is the asset component in your balance sheet will become worthless or non-performing, or it go into a loss category. And if that happens, also you will have credit risk. So if you have recorded and have a potential, have a substantial amount in your NPA, so those banks run higher credit risk than a bank doesn't have much NPA. So credit risk is that. Moving on, before moving, actually, I would like you to take a piece of paper. I hope that you will have pen or pencil with you for you to understand the very important area of your bank's balance sheet, because this is something to do with some kind of little bit of accounting knowledge. for you to understand where credit stands. Where your balance sheet is concerned, the highest risk in that balance sheet, in terms of money, we call it credit risk. To explain that, I need to draw up a sample balance sheet of a bank. Now, we'll do it in a small way. I mean, rather than building up a overall balance sheet of a bank, we'll do a very summarized balance sheet. On the balance sheet is your assets and liabilities, and they are equal in your balance sheet. So on the asset sides, we have current assets. So you can write the current asset as CA. Then also you have fixed assets, your land, building, your computer systems, um, various other equipment what you have are your fixed assets. If your vehicles, all the other assets physically available are called fixed assets. So your current assets plus your fixed assets is your total assets. So these two, that is CA plus fixed assets, will give an abbreviation FA, is equal to, on the other side, we have to list out liabilities. Now, you also have, the first thing is current liabilities. We'll give a abbreviation to that CL. Current liabilities include the money what your depositors have been placed in the bank, because those are actually payable whenever the request has been made by customers. So we put them under current liabilities. Then we have long-term liabilities. So CL plus LL stand for long-term liabilities. Those are the monies have been given on long-term basis, like debentures by those debenture holders. They generally place debentures for 5 years, and as a result, you have a long-term liability towards them. So we'll list them under long-term liability. Plus, you also get your shareholders' money. Shareholders' money, we call it equity. And then, so our balance sheet consists of like this, CA plus FA equals CL for credit current liabilities plus LL for long-term liabilities plus E for equity. So this is your sample balance sheet in your bank. And if you see me, I can did you see the paper which I'm holding?
Not clear, sir.
Okay. So it's something like this, what you have drawn. I also draw myself. How is it now? It is CA plus FA plus CL plus LL plus E, right? So that's the balance sheet of a bank. Under current, now we'll say, we'll give some figures to this. We'll say your total balance, either assets and liabilities, equal to 100 billion. If you have a 100 billion balance sheet, generally this 100 billion is consist of banks doesn't have, when compared to their current assets, have a very minute fixed assets, because we have all the monies what the customers placed. We are not going to put into machinery, uh, buildings and all that. Some of the banks would like to even rent out their branch premises, because those monies get fixed and they are not earning money. We are not manufacturing company. No, we don't want to invest money on machinery and other things. We want to invest by way of either in the market by buying government securities or gold or whatever, or rest of the things what we need to is to give away as loans. And then those loans are giving us a much higher return than what we pay to our depositors. As a result, we make money. So under current assets of the bank, there are three major items. One is cash. Banks are financial institutions. In order to manage risk, we need to keep a lot of cash, because whenever there is a demand from a customer, we need to pay. So banks will keep money in the counters, money in the ATMs, money in your wallet, and also money in the central bank account. Now these monies will not earn any interest, but banks are supposed to keep about, we'll say, 100 billion our total balance sheet. We need to keep at least 7% of your total assets in the form of cash. That's a kind of a direction given by central bank. So banks will have about 7 billion now in our balance sheet, 100 billion, 7 billion in cash. Then we also need to maintain liquidity ratio. We call it statutory liquid asset ratio of 21%. To maintain that, you need to have cash plus some other asset which can convert into cash quickly as possible whenever there's a demand. So for that reason, we invest some of the money what we take from customers in treasury bills and bonds or government securities. So to make 21% with cash, I put a figure of 14 on the investment. I put 14. So next item is investments. Value I have given is 14. So under current assets, you write cash and put a dash and write 7. Then under your current, under your investments, you write 14. So out of this 100 billion, we have already used up in order to oblige our central bank and to our customers. We have kept about 21%. Generally, banks' fixed assets are about 10% of the total assets. So on top of your FA, you can write 10, and of your top of your CA, you can write 90 to make 100. Now, below your CA, we have put cash as 7. Then we have put investment as 14. To make 90, the total balance, the other item comes as loans and advances. So loans and advances to make 90, 90 minus 21 is about 69. So you write loans and advances and put a dash and write 69. So now we have built up our current asset base. It reached total current assets is 90 billion. And we have divided that 90 billion into three items called cash, 7, investment, 21, and loans and advances, 69. Now what I want to show here, then you have your fixed assets 10, that will be your total assets 100. On the current liabilities, generally most of the money come from your customers' deposits. So current liabilities, I will put 85. Long-term liabilities, I will put 5. And equity, I put 10. So that makes the 100 on the other side. So our balance sheet balances, that means we have current assets 90, we have fixed assets 10, that is 100. Then on the liability side, we have 85 on the current liabilities, plus long-term liabilities, we have 5 and 10 as equity. So then that also work out to 100 billion. So our balance sheets are balanced. Now, what I'm trying to get here is the division of your current assets. The division of current assets stands at cash 7, investment 14, and loans and advances 69. So if you take the total assets as 100, 69 billion is being shown as credit or the loans and advances. So where balance sheet is concerned, that is the highest amount on a highest single amount where your current assets are concerned. So that asset, that 69 is exposed to credit risk because that 69 is not with you. You have already given that money as you have lent that money to your borrowers, and the money is with them. If they don't pay, you will get subject to credit risk. So you understand our balance sheet now, and the highest or the largest risk in the balance sheet is concerned is the credit risk. So we need to pay a lot of attention to manage this credit risk in order to survive and make profit. So we'll see how we are going to do it. For this, you need to understand this process very well. Actually, I have divided this process into two. One, I call it a credit management. The other one, I call it a credit risk management. So far, what we have learned from other presenters and other resource person or the lecturers is the credit management side. You may have done how to originate a loan, how to get the information required to process a loan. Then you may have learned how to evaluate the customer's proposal, how to get the financial ratios right. You will take the balance sheet and you will run the ratios like liquidity ratio, profitability ratio, solvency ratio, all that you may have counted. Then also you may have seen the qualitative aspects like the market share what your customer has, how good is the management style, what is the reputation of the directors, all that you may have done under qualitative analysis. Once those have been satisfied, you think the customer is credit worthy, and then you approve the credit and take securities if you require, and then you disperse the loan. Thereafter, you will have monitoring and review process to see that they are paid. Now I want to know how far you have gone with the other. I'm not aware how far you have gone. For me to touch on the credit management side, because credit management also is a kind of risk management, because people in the business side is the one who are involved in credit management, because in your bank you will have a risk management unit which is a back office function. They don't deal with customers actually, therefore they don't know much what's happening in the business side. So business side, what they can give is certain directions, they can give certain controls, they can give certain procedures for you to manage your credit well. So actually, the risk owners are the people who are actually giving credit, actually looking at the customers and deciding whether their customer is credit worthy. So to do that, you need to actually understand this credit management. There are actually two sides of a coin. The credit management also very important in order to manage risk. If you give to a wrong customer and they don't pay, there will be a credit risk. And if you don't take proper documentation and then your evaluation is not right and the default occurs, again, your credit management has not been done. Credit risk management has a role little bit different to the people in the business side do. Their back office, I told you, people think, a lot of people think they don't do much work where credit is concerned because you have to deal with the customers, you have to call for their statements, you have to do the financial analysis, you have to do the internal credit rating, all that what you need to do, you think they don't. But they also have a lot of other things when you have started giving facilities because nowadays, at the time of evaluation, you need to pass your credit appraisal form or the application to the credit risk management for their recommendation and concurrence. So they also do a great part in credit process that we will discuss in very detail because that's our subject. But uh, if someone can let me know the things what you have learned already, um, have you all done the credit origination part? That means, uh, or I would start from the customer. Have you all done? How do you get credit customers, or how do you do market development? We call it, or business canvassing, or whatever terms we use in banking, uh, and then taking the required documentation. Like for credit origination, you have to ask right questions and then ask for right information. So, can someone unmute their mic and say if you have studied this part? How to process a loan, how to take an application, what kind of documents you need, what kind of information you get from customer. Have you all done that part? If you answer me, it will be very easy. Nothing wrong. If you have not done, I will also try and use some. It is not majorly in my part of the syllabus, but there is a special module for that in the credit management diploma. Uh, or can someone tell me now this credit management? You have different modules, no? You have different lecturers coming in. Uh, can someone tell me what you have done so far? Yes, Damin. You can unmute your mic. There's no harm. There's no right or wrong answer. Just tell me so far what you have done, or is this the first class? Come on, bankers must be much more forward-looking to answer me. I know we are not meeting physically, so therefore it's difficult, to have a interactive conversation on this. Any language, මෙච්චර කල් මොනවද කරලා තියෙන්නේ කියලා මට කියන්න පුළුවන්. Or you can send me a chat. Since nobody's giving me a clue, I will go on. So I will touch upon the credit management also to a certain extent, because these particular items which are on this credit process, they are credit origination, credit evaluation, the financial ratio calculations are done by other lecturers. Therefore, I'm not going to do very much detailed analysis on them. But for you to understand, I mean, need to go there. Um, so first of all, I'm going to touch upon the credit management side. Um, rather than moving on to credit risk management, because you need to understand credit management well if you are in the business, because you are the, we call it, you are the risk owners of the bank, and or the risk takers of the bank, because you deal with the customers and you take the first risk. The management side is, back office function. They are not dealing with customers, therefore they can only advise you, set certain guidelines for you. But face to face, you meet the customers and you are the one who's going to do the initial evaluation to see whether the customer is creditworthy. So moving forward, our credit risk management, I am first want to give a classification to this, because on the credit management side, the risk come from non-payment, but also this non-payment by customers is, we call it a counterparty risk. So credit risk management, we have classified under credit risk, we have classified under two. One, we call it a counterparty risk. The other one is a concentration risk. So two types of risk involved in credit risk. Counterparty risk is look before you leap. That means when customer defaults, either capital, interest, or if they don't pay on time, you will get subject to counterparty risk, as we told earlier. So you need to actually look before you leap. You need to think before you jump, and accept a credit facility or grant a credit facility to a customer. So you need to make good credit decisions. That means your evaluation should be right. You need to understand your customers. You need to analyze the information right. You will need to see whether they are within the bank's policies. Then you need to actually apply their information into various systems you have in the bank, like internal credit rating module. Finally, you use your experience based on the outcome of those information and analysis. You use your experience and judgment to give credit to the customers. So you need to be attractive to customers, and you need to be fast, and you must need the right pricing. You must need to if you charge a very good customer very high rate, the competition is such, he will move on to your competitor. So while you understand the customer's business, get their information right, do the evaluation right, and then you make a decision based on that, you also need to be quick in your decisions. If you delay long, the customer might go to the competitor, because nowadays there's a huge competition um, by banks, because in this country we have 26 banks. Considering the size of the economy, it's a very large number. On top of that, we have some 50 odd finance companies. Also, they're also trying to take the market share of credit, and therefore you have a huge competition. So you need to have the speed, have the right price for your credit, and you also need to have the correct judgment selecting your credit for the client. Otherwise, we will face the counterparty risk. The other type of risk is created by you, bank alone. It is nothing to do with the customers. If we decide to lend to either one product or one area in the country or one industry type, we are putting actually all the eggs in one basket. Now, say when some banks, when this pawning facilities was introduced somewhere in 2011, they thought this is the most easiest and secured way of lending because you have a very valuable security because gold is given to you and it is kind of asset lending. And a lot of banks went on a very big way. Each of their branch had a small section for pawning and they did a lot of advertising and they finally collected a very large pawning portfolios in their loans and advances. And we also, some of the banks made a mistake by giving if the one sovereign is equal to say 100, they went up to even 85 percent, giving 85,000 for a one sovereign as a loan. But that time they were not thinking of any losses by way of lending to or taking a bond and giving loans. But in 2012-13, the market price of gold fell very sharply. Generally, market price of gold is given for a 1 ounce of gold in dollars. I think currently it is about $1,300 per ounce, 300 odd. In 2012, this particular price fell down to something like $900 per ounce. So you can see it's almost 25% decline. And if we have lent for one sovereign 85,000, 25% decline means the gold what you had then valued at 75, whereas you have given the customer 85. What happens? These customers may not redeem the gold. As a result, you have to auction them at a lower price and suffer loss. So, this sort of selecting one area to lend, like some banks go hell together with leasing. Now, those days leasing if the interest rates goes up in the market, and if you are lend at a lower rate than what is prevailing in the market, once again we will suffer loss. So selecting one particular area to lend is we call it a concentration. Generally, even if you are in a branch, you must actually diversify your lending portfolio. That means central bank has given various industry types like agriculture, transport, tourism, trade, manufacturing, like that. They have given about 11 categories. So you need to actually your lending portfolio should go into each of these industries. If one industry fails, then you are not going to have a loss. Now, for instance, I'll take like this. We had a tourism boom before 2000, end of 2019. From 2015 to 19, we had a higher level of tourist arrivals and a tourism boom in the country, and this particular industry was performing very well, and people started businesses related to tourism in a very big way: hotels, lodges, various other areas, supporting tourism. They started businesses, and what happened was, when the COVID struck, uh, we there were no tourists in the country, and most of these places has to close down for a long period of time. As a result, the tourist industry suffered a huge loss. So, if as a bank, if you are in your loan book, if you have lent majority during the boom period for tourism, what happened is now you have selected the industry which is now not performing. As a result, the customers who have borrowed money in that area or that type of industry now unable to pay you back, and as a result you will have a large NPA. We call this type is a concentration. So there's a wording, they say don't put all eggs in one basket, because you trample the basket, and there are going to be a lot of breakages. Similarly, not to put your money or lending into one industry type or one product type, then if that fails, you will have large NPA. So as a result, you will have a credit risk in that your portfolio. So you need to establish sector limits. So banks have this, they have divided according to central bank guidelines, the industry sectors, and your credit department has recommended the limit to each sector, and they have got the board approval to that, to have that. With that, they will manage the concentration risk. You also need to manage uh, these portfolios, like also we call it asset portfolio, of leasing portfolio, owning portfolio. So sometimes if the amount is high, you need to actually think of another way of mitigation those concentration. Um, there are ways how you can do it. So we will discuss that when we go on. So majorly you need to understand that two types of risk in credit risk, counterparty risk and concentration. Concentration is coming from your own act. If you are not going to diversify, you will get concentrated. Counterparty is coming from again you are selecting from customers. Therefore, mainly the counterparty risk arises from your business unit. Even concentration arises from there, but then need to be guided by the risk management to not to concentrate on that. Therefore, the portfolios are managed, limits are set by risk management as a guideline. So this is the two categories we need to understand well, and we will see how you manage your uh, credit management side. Those process where from customer coming in and then originating, the process of taking information and then evaluating and granting is the credit management side, and we will see if those are not managed, what happen is you will have a NPA. Similarly, if you concentrate in one industry, if that industry fails also, you will have a high NPA. We'll see what makes customers default. Now here I have divided for you to manage the risk. We say you need to understand why, or we need to identify the risk. Uh, that's what we do when we do evaluation. So what make customer or counterparty fail to meet their financial obligations? So why customers, I have divided under this as again to individuals and businesses, because their behaviors are too different. Individuals will default either willfully. We have customers who has money, but they don't pay the bank. They think one day bank will give a concession and they will have to pay a less amount. We have this type of customers, we call them willful defaulters, and you've got to be very careful in evaluating them. Or individuals, due to unemployment, they lose their income stream and then they will default. Rising interest rates or cost of living. When they borrow money, those monies are not only going to the businesses, certain profits coming out of the business will be used by the owners if they are individuals. When the cost of living goes up or the interest rates goes up, then their um, finance cost and the living cost is going to go up. As a result, they may not have sufficient money to repay their loans. Death, illness, and medical bills, these are also certain factors which will have an impact on customers' profitability and repayment capacity. As a result, we will have losses. Asset price volatility. If the money has been borrowed for share trading or that kind of activity, if the price of shares falls and then the value goes down, then bank can expect non-payment if the facility is being taken, and then it will go to NPA. Loss of assets without insurance cover. Some guys borrow money to buy certain assets, and they don't insure, and something unexpected happen to those assets, then their income streams go down, and as a result, they will default. Businesses come from poor sales. If they can't sell their product, they can't make money, and that happens due to new competition. Uh, Change to prices, regulation, and technology also sometimes affected the businesses. Now we see prior to COVID, we never had restriction on vehicle imports. Now regulation says that no vehicles can be imported. As a result, those customers who are in that trade now lost their business, and as a result, the loans taken by them may come under NPA. Loss of key customers, suppliers, and employees. If business is depending on a single or key customer, and if they lose that, then until they find um, other customers, there will be a period of losses coming to the customers. Mismanagement of cost and liquidity. These are very evident. That's why you look into financial ratios of your customers before you lend to see whether they are managing finances are all right. Because any businesses which cannot manage their finances, ultimately you can expect losses on that business, and as a result, they will default. If there are lawsuits, disputes, frauds in businesses, also those could affect their repayment. So these are some of the areas which I think which will happen in NPL. Inefficiency of poor governance and credit culture. Sometimes banks also a little bit lenient and try and give to one area of work, area of industry, then you will have excessive credit concentration. Heavy relied on collateral. Now, rather banks also do this mistake. If the customer provides collateral, they think they can lend without looking at whether the customer is making sufficient money to repay. Finally, realizing collateral is another huge exercise, which may end up in uh, part payment of interest, part payment of capital. All this will lead to credit risk. More liberalized lending practices, pro-cyclical credit policy. Sometimes when there's sufficient funds, we think that rather than invest in other areas, we think we must lend all that to customers, and then we become very lenient in our evaluation. Those things also will lead to credit risk. Lending to low income and risky borrowers, considerable lapses in security documentation. So here they are giving little bit attention to credit administration. Uh, Not only you are giving credit, you need to keep your documentations perfect in case customer defaults, for you to um, take action against those. If your documents are not in order, you will have a problem. So these are some of the reasons for uh, customers to default, and Do you hear me?
Yes, sir.
Yes, sir.
Yes, sir.
I'll go to the presentation once again. Right. Now, actually, I'm trying to do the credit management side. Credit management side, I put a slide called credit process. Customer comes in and then I put as loan origination or credit origination. Now, in this, so far, to originate the loan, you need to have information. So it's very important that you collect the correct information from the customers. Where this is where you give a application form, to fill the customers. Where if it comes to a retail credit, you give a loan application for customer to fill it. If it is a corporate customers, you need to get a lot of information from a customer. Like, you ask for 3 years audited balance sheet, you ask for company profile, you can ask various financial and non-financial information from the customers. You ask Form 48, who are the directors, current directors. Then you run through a crib report to see whether they are in the crib. So various information you collect before you do the evaluation. And you ask for various qualitative aspects, what product you do, what is your market share for that, are you exporting or you are selling it locally. So various uh, uh, information you require from a customer. Now, therefore, this information, what you get from customers to customer will differ. And therefore, your evaluation process for different type of customers also need to be differed in a different manner. You have to do it. Now, for that purpose, I actually divide your customer portfolio into three parts. I call it retail, SME, and corporate. So retail customers are mostly individuals. Uh, this will include your credit card, your mortgage loans, your personal loans, your leasing to personal customers. Uh, so these are uh, retail credit or to individuals who borrow for their own businesses under a single name also will come under this sometimes, but they can be categorized under SME also. So mainly we use a different method of evaluating these three different type of businesses. Retail customers, we generally do a thing called credit scoring method. Now you give a form to a customer and you will have about maybe 20-25 areas the customer need to fill. His name, address, then you will ask for his marital status, you will ask for whether he has his contactability, telephone residence, telephone office, telephone mobile. All those questions you will ask. You will ask whether you have any assets, whether they are in mortgage or they are unencumbered. So various questions you will ask this form, and those are actually why you ask in these details is to evaluate your customer. So whatever credit scoring method what we follow is to each of answer what the customer give for your questions will carry a different marks based on his answer. Now I'll take for an example, you evaluate a credit card customer and there's a question for his contactability. You will have three areas where customer. You ask for his office number, you ask for his residence telephone number, and you ask for his mobile. If your customer only give the mobile number, uh, how you are going to score him? If he give all three telephones, his contactability is 100%. So under that questions, you give 100 marks to the customer. If we give mobile number, you may not give 100%, you might give 50%, because this mobile connection he can change. There's no fixed way of contacting him. Um, he might change his job, he must change his residence. There's Then he can change his mobile. You will finally finding it difficult to trace him. So you ask that question of all these telephone numbers to contact the customer in case of a delay in repayment or whatever. So if that is you are covered with 3 numbers, you are 100% satisfied with this customer. So under that you give 100 marks to this customer on that particular question. So what we'll do is, similarly, you have a lot of other questions in this. You will have state your assets, then he will say house and car. Then the next question is whether they are mortgage or leased. If the car is leased, it carries lesser marks than if car is in his own name. If his house is in his own name without a mortgage, carry higher marks than if it is mortgage. So based on those methods, you start accumulating the marks what he has, marks based on the answers he has given to your questions or the parameters of your loan application form. Then you total up all that and get a percentage, average percentage. Then that average percentage is above a threshold where bank has agreed to give credit. Then you pass this customer's loan. Now say your answers to all these questions, we'll say we have 60% total score. If you think that anyone who is scoring more than 50 is eligible to that credit, then you give facilities to that customer. So that method we call it a credit scoring method. That generally we apply for retail credit only, because sometimes you cannot completely make your judgment based on the answers what the customers give. In those days, we have another traditional method to evaluate retail credit. We call it 5 C's of good credit. This is based on 5 areas of considering the facility for a retail customer. The first is character. Now, you don't ask for a character certificate from a customer, but however, you need to establish his trustworthiness, integrity. That's why you ask for his previous bank statements to see his track record. He has overdrawn or any check returns are there. All that you can actually judge. Similarly, you can call for crib report to see whether he has previous bad loans. What you are trying to establish is whether these customers, where character is concerned or the trustworthiness or the integrity is concerned, whether those information will give you bad marks for this customer. If not, we consider if the character is or the past track record is good, we consider that he has scored under character. Capacity is his repayment capacity. You ask for employees letter or the pay sheet. That is to see whether he has a regular income, and that is his repayment capacity. If he has regular cash inflow and continuously it is coming, you think he has the ability to repay the loan what you have given. So capacity is that. Capital is whether he has a certain amount of assets. Now, you remember we asked the question whether he has his own house, he has his car. In that we have mentioned if it is lease, then he has commitments on that. If he has mortgage, then he has commitment. If not, those are actually his assets. If you draw up a balance sheet for this customer, so he has assets in case of a very emergency or at the last resort, he may be able to dispose those assets and make good your money. So capital is also important factor to consider. Conditions. Conditions is for what purpose he's asking this money. Nowadays I can see most of our personal loans given by banks, this purpose is not mentioned. They say it's a personal reason. It could be for air travel, or it could be for sickness, or it could be various things. If you know the purpose, it's much better, because sometimes customers ask for money for income generating purposes. Then in your cash flow, you also need to add any income generated out of your loan into their cash flow to see whether their repayment capacity. Now, say if you only think of their current income from employment, then you can think of a personal reason for the condition as a personal. But other than that, anyone who is asking to do a business, you also need to know what type of business he into, why does he need this money, how does his business perform in the economy. Now, say nowadays somebody come and say, okay, I want to start a small hotel and come to you, and then you think that purpose itself is not very good idea, because the economy is not doing well in that area. Finally, other C is the collateral. In case if you have doubts in the other four, where character is not good, capacity it doesn't have cash flow, capital is doesn't have, the purpose also not a good one, acceptable one. That those things will represent risk. That means when there is risk represent, you need to, we call it, mitigate that risk, or you need to bank should not take such a risk without having a backup plan. Now, so that backup plan is, we call it a collateral. That means in case some risk occurred to the customer, and if he fails to repay, or he doesn't have a cash flow, the ultimatum is to realize the collateral what he has given, and then use that collateral to get your repayment going. And so those are for retail customers. Remember, we can apply credit scoring method for retail customers, and also we can apply good C's of 5 C's of good credit for your retail customer. But this particular methodology, I don't think it will apply for other two types we are going to discuss. So when you are evaluating, you need to actually know the way how you are going to evaluate a customer based on his type of the customer. Retail customers, these two methods is good enough and generally accepted. Now, I move on to the next sector. Next sector is the SME, small, medium enterprises. Now, central bank, we think that small, medium enterprises means the small businesses, but now central bank has given a criteria to which small businesses will come under SME. So that's what I put before and current. Before, all the small businesses come under SME if they are not corporate customers. But nowadays, you have SME customers in different types. Underneath this pyramid under current, we have mass employed in the slide, and those are the micro businesses. What we give microfinance is to this particular sector. This sector is actually doesn't borrow large amounts, very small loans what they take, and the businesses are generally, I have put mom and pop outfits, or those are actually kind of family business. The owner himself manage the business. Generally, this sector is not served by banks very well because they are not in the town. It's not very easy to reach them. They are in more or less, in villages. Uh, they don't have transport to get to the bank every day, so they don't put money. They will do some kind of agriculture or some small cultivation or small business in their premises itself, and therefore um, you cannot actually expect them to come to the bank and borrow money. So that's what I said, they are sometimes underserved. They will be served under several other schemes in the microfinance. Main problem is they don't have uh, collateral, they don't have any papers. They write in a small book. They have to write if they know how to write. Otherwise, no records of businesses is been there for you to evaluate to evaluation of your facility. So their management is at a very primitive stage. Therefore, difficult to evaluate that kind of management. The second type is middle of the pyramid, and they are actually classic SMEs. They are the real SMEs. Mainly, they are in retail trade. Once again, the owner manage. About 3 years in operation on a very small scale, but they are building up. Usually served by the bank and the retail or consumer bank. That means they expect small loans, not corporate loans, um, like for asset finance or to do cultivation. They ask for the purchase of seeds, um, fertilizer, and that sort of thing. They are branch dependent. They don't go to your corporate office to borrow money. So to serve customers, that's why most of the banks have huge branch network, because we have in our economy majority are small and medium enterprises. So this sector is important for the economy, and therefore they need to be financed by the banks. Now then we have on top of the pyramid also SME, but their borrowings are less than 35 million, and their annual turnover is less than 600 million. So anything over 35 million borrowing and 600 million um, turnover are generally central bank classified them as corporate. So anything below that uh, are actually SMEs. They are kind of a commercial SMEs. So they are large SMEs. Generally, to get into this stage, they must be in operation for about 5 years. They also have a place in the town. So in towns, now each town you have several banks. So they are banking with not one bank, so multiple banking relationships they have. So they high value emphasis on relationship. So any branch which serve them one to one and consider them as one of their best customers, they will remain with them. So they value that relationship very important, and the uh, consideration of them being uh, high value customers in that area also affect to get that business for that particular bank. So these are the three types of SMBs we have, and SME evaluation is not very easy because they maintain books not like the uh, microfinance, but they are very scared of internal revenue. So they prepare two sets of books, one for internal revenue and one for the bank in order to borrow money. So we don't know which one is correct. For the bank, they will produce a income statement and a balance sheet very much higher than the actual wealth or the income. Where Indian revenue is concerned, they will show 10% of all their revenue in order to avoid income tax. So the financials, what they produce, they're not 100% accurate. So you may need to sometimes create their finances by visiting their businesses, looking at their operation, how they manage their business to determine what kind of financials, what kind of wealth they have, what kind of assets they have in their portfolio. So analysis of risk of default due to business failure, willful default is to be done. So that you need to actually do a lot of judgments where SME is concerned. So financials, sometimes you can ask, but you cannot 100% rely on them. So therefore, you need to actually verify those financials. Now, I'll take for an example. Okay, you have a retail customer who has a grocery stores, and he brings his financials and he says his annual turnover is say 10 million or 12 million. That means monthly he does business for 1 million rupees. So you need to actually verify this. How you do that? You go to his business premises and you observe yourself how is the operation going on. Sometimes if it is a retail trader, you can ask few questions. Like you can ask how many days you are open. Then he will say, other than per day, we are all open. So in a month, he does about 30 days. Then you can gradually ask, in average, what is your daily turnover? So if he says he does 100,000 a day, so in a month he will do 30 lakhs, 3 million. And then you divide you multiply that into 12, then 3 million into 12 make 36, whereas his finances he has recorded 12 million. So you know that he does 3 times than what they already declared in your balance sheet. So you can apply that into rest of the areas, and then you can create his finances to arrive at his profitability and various other things to see how he manages finances. So finances versus management, you need to actually check. Now, most of these customers, SME customers, come to you and say, so I would like to keep my house and property, and will you give me this much of facility to do this business? Now, those are actually kind of collateral. You have the cover, but you don't know whether he's making money. So you need to actually see how, why this money is required, and with that money, how much is going to generate income. So you need to ask various questions to arrive at his cash flow. What type of business, from that how much you get annual monthly turnover, for which how much you draw for your personal requirements, how much is available for the business. So you draw up a kind of a cash flow to see whether in that cash flow, in cash flow in and cash flow out, the net amount should have a higher amount than his repayment to the bank in order to consider his repayment capacity. So you need to actually do certain manually. You have to check various items what customer does and build up a repayment or a cash flow rather than completely relying on the collateral for your lending decisions. Past records versus future prospects. Now, these SME customers, we say some businesses are not doing every day right. There are times, they face a lot of problems, and sometimes they may have gone into overdues, but later they have paid and come back. So you need to actually, past record will help you to see why, those are the lessons learned, why he has failed, um, how he has come out, and you also need to check his future plans. You must see the loan, what his request is going to invest on what type of business. Is the same type where he has past defaults, or he has started a new business which is more lucrative than what he's been doing. He also trying to diversify his business. Then not only considering the past records, you can give loans, but you also need to check the future prospects based on the money what you're going to give him, how he's going to allocate those money. So those are important. Those are actually, you have to build up by asking several questions from these customers. So you need to understand the customer's business well if you are to do SME lending. Company versus industry. Now say most of these people may not have a company, either they must have a partnership or individual registration. Sometimes they even can incorporate a company. Now company performance you can judge from the records, financial records. But if this company is in an industry which is not performing, then you need to be very concerned. So once again, sometimes the industry may be doing well, but his company is managing not well, then you have to decline. So you have to actually consider how does even a very good company in a bad economy, they can actually come good with repayment. For instance, I would say, okay, company has the flexibility to change their businesses quickly. Now they may be in tourism, so you think tourism has failed, so this customer will fail. But customer comes with a proposal saying that we are trying to do e-commerce and um, do catering by way of home delivery or whatever. And if they present a good report, since they have the capability of making very delicious food in their current business, so they can actually create a good market by finding a different way of delivery rather than to have a place where customers could come and eat. So these evaluations you need to be done, and therefore mainly your experience and judgment is very much needed if you are to uh, do the SME evaluation. And most of branches we have SME customers, so you need to actually give SME credit, not only looking at is their finances, but based on their businesses. You may need a lot of experience and gut feeling in order to consider facilities to this type of customers. We consider them as small medium enterprises. So we have evaluated two types now. We have SME, you have to actually get or create financials and compare their management. You also need to create the cash flow, not only just relying on collateral. You also need to look into their past records, whether there had been failures, why it has been failed, but also you need to look into their future prospects of repayment. Then also you need to look at their organization, whether company or partnership, what is the expert knowledge they have to recreate, if even the industry fails, whether they can make money in order to repay your loan. So these are very important ways of evaluating SME clients. Now we go to the other type. So we evaluated now SME credit. We evaluated individual credit. Now we come to corporate credit. Uh, this is where your analysis is very much required, because corporate credit, we consider the corporate credit, the basic information what you get is 3 years balance sheet. Sometimes you can ask further financial information like age analysis of debtors. You can ask for their stock statements. You can ask for their management accounts, because sometimes this balance sheet is historic because they have closed their businesses in the financial year, sometimes March 31st. If you are to get the facility in December, you are looking at the March finances, then those finances are kind of a historical records. Maybe during that time the business have failed or business have gained, you don't know. Therefore, you need to actually ask for management accounts. Management accounts will give you the last month's uh, position. Then you also in a position to compare how it was at the year and how it's doing on a monthly basis, whether they are in line with achieving their profitability higher than the last year. You can determine. So you can ask this information, and this information, especially audited financials, you consider them as your source document, because um, you rely on the auditors to do a proper audit and then verify these figures what the company has given, and the company's actual financial position represent from their financial statements. So your complete reliance on customers' creditworthiness or the assessment will be based on the financial reports what the customer has provided you. So you can rely on them and make your judgment. We call them, the bankers, we call them balance sheet lending. Where corporate customers are considered, we sometimes call them, it's a balance sheet lending, because you consider their balance sheet is totally accurate and you can rely on. So lenders can have approached different approaches, but traditional lenders generally follow this approach, and this approach also considered the good model to have, like the 5 C's of good credit. You have these 4 sections under which you ask several questions and you build up your credit appraisal firm based on these 4 areas. The purpose of lending is very important where corporate customers are concerned. You need to know why do they need money for. It's not like a personal loan. Personal loans, you rely on their current fixed income for repayment, but where corporate is concerned, if you give money, you are giving to the company, and company, what do they do matters in generating income, or repayment capacity will build on amount of money what they borrow and for what purpose they have been utilized is very important. So the purpose of corporate credit is a vital information which you need to get in order to analyze customers. Now, corporate, the purposes, I want to ask the questions. What are the general purposes these corporate customers ask money for?
For working capital?
Yes, very good. they ask for working capital. Now, working capital is generally the difference between their current assets and current liabilities. That means the customers, where corporate customers are concerned, the current assets include, not like banks, their current assets include, they don't give much cash. Sometimes even the account is overdrawn, so it is on the liability side. They need money to build until the debtors have been paid or the stocks have been sold. They need a lot of money in that area, mainly for debtors and stocks. So these current assets minus current liabilities, that means they get money from creditors who supply their raw materials on credit. The difference between is, we call it a working capital, and this working capital need to be balanced with the facility from the bank, which will appear in their balance sheet under current liabilities. So that comes from either a short-term loan or by way of a overdraft. So working capital is a kind of a very acceptable purpose for the bank to lend money, and then we generally provide overdrafts and short-term loans to fund this working capital. Any other purposes? What about fixed asset financing? Now say this, corporate customers need machinery, they need sometimes buildings, they need plants, computer systems. So these assets are being used to generate income in the company, because those are part and parcel of income generating assets in their balance sheet. And sometimes when they get outdated, they have buy new machinery. So another purpose of corporate customers asking money is to fund plant and machinery. So generally, if you have done with other lecturers project lending, we consider this type of we consider the internal rate of return on these assets. How long, when you depreciate this, how long it will take for you to generate income, and if that generation of income is higher than the replacement cost of a new asset after deducting depreciation, then you consider that purpose also good. So asset financing is another kind of a valid purpose of the bank, of the corporate customer. Now I'm going to ask you a question which, if a corporate customer says, I have a facility from bank B, which is also appearing under current liabilities in their balance sheet of, we'll say 50 million, interest rate applicable is 12%, which he thinks, which is very much higher than the current market rate. And you have given a facility to him at 11%. So the customer says, I prefer for you to take over the facility given by bank B, which is at a higher rate, and consider this facility by your bank. What do you think? It's actually, purpose here is a repayment of another loan, repayment of another liability. Do you consider that as a good purpose? I know bankers are very conservative lenders, and I told you in the beginning, where corporate customers, you completely rely on the customer's financials for decisions. We also said that it is balance sheet lending. Now, when you give a loan of another 50 million to this customer to settle that facility, what happened is only nothing will change in their balance sheet. Only the provider of that loan of 50 million from A to your bank is, if it is B, B to change of A and B only. His financial position doesn't get changed, and his repayment capacity will improve because he is now enjoying a lower interest rate, and his finances will improve rather than before. So if a customer requests that kind of a purpose, also if it is not going to change his balance sheet, and if you have accepted this balance sheet as a good one to lend, then I don't think getting a facility of another bank to yourself is not a bad idea. So um, this kind of purposes also will come on your way. That is to settlement of a liability. Sometimes the settlement of liabilities will come not only to settle other banks. They will say one of our directors wish to resign, but we don't have a new director who is going to take his position. His shares we need to buy back, and for that we need a facility. So what will happen in this liability side? The shareholders' funds will get reduced because that director is going to go out, and if you're going to give a loan to pay that facility, his current liabilities will move up. So what happens is the change will come in only the debt equity ratio, and if that happens, we will discuss what is debt equity ratio, and that is the purpose they are giving, to settle directors, and they are going to buy back shares. So this kind of purposes also will come in your way for you to consider, and if that purpose will not change adversely on the debt equity, sometimes banks even fund this. So these are different type of purposes your corporate customers will land on your table if you're going to evaluate their facilities. It's not only working capital, it's not only asset financing. They might request you to uh, repay an existing liability and create a new liability under your book. Also will come on your way, and then those are kind of accepted norms of corporate purposes for monies required. The second box represents payback. Payback is a repayment. Now, corporate customers, I told you, it's balance sheet lending. You are completely relying on the customer's statements, what he has given. So payback comes from his income statement. That means his income statements will have, top line called his revenue or sales. Then you deduct cost of goods sold, or then you arrived at gross profit. And from gross profit, you start deducting his depreciation, selling and administrative expenses. Then you arrived at his operating profit. From that operating profit, you deduct his interest or the finance cost. Then you get profit before tax. Then you deduct tax, then you will get his net profit. So mainly the payback come from the profits generated by the customer. We call it profit is being used to repay the customer's loan. Here we also need to be a bit careful. Profits are actual book entries. If he has in his balance sheet large debtors, and he has shown sales by way of accumulating debtors, but the cash has not been generated, because they are lying in the balance sheet as debtors. Therefore, bankers ask for mainly three types of financial statement. We ask from customer, income statement, we call it profit and loss account. Then we ask financial position. Financial position is called balance sheet. Then we also ask for cash flow statement. Cash flow statements give you the exact position, how much cash flow profits this customer has generated, not the book entry profits. You need to have cash in order to repay the loans. It's not only on the books. Debtors will not be able to, get you money into your customer's account. Therefore, where payback is concerned, profits are the main subject, but also bankers, generally they say banks dreams on cash flow profits of a customer in order to recover the financial obligations of the customer. Any other way customer can pay back other than the cash flow profits. Sometimes these corporate customers will approach the bankers and say, I want a loan, but it is not on a monthly repayment. I will pay back after 1 year on liquidation of an asset. Now, this sort of a thing, how do you look at it? Generally banks don't like, liquidation name of a customer. The word liquidation by your corporate customer means you think that he's going out of business. Now here customer says, I will repay by liquidation of an asset. So in banks, in the customer's balance sheet, there are various assets. Some of the assets are being directly used to generate income, but there are also some assets are there doesn't generate income, but they are in the balance sheet. Now we'll say, for instance, customer has his business premises. We'll say it's a 1 acre property. His factory is occupying only 20 perch area. He may need another 20 perch for parking and various other conveniences. Then when you say 1 acre, it has 160 purchases. So rest of the 120 perch is just a bare land, not generating income. But it is the value of that is in the customer's balance sheet. Now, customer thinks he wants to sell part of this land and to generate additional funding for enhancement of business, but he has not got the right price yet. So he says he will demarcate this particular portion what he's going to dispose and show the bank and the valuation of that, and he'll say this is available for sale. Board has already taken a decision to sell this, but until the sale proceeds come, I may need a loan. So he will say liquidation of assets, because that portion of land is also his asset, and the repayment comes from when he disposed that particular asset, and then money will come. And so when you say that kind of thing, these sort of repayment also considered valid because those are going to generate cash flow to the customer. And sometimes bank may request, okay, if you have a sales agreement or something like, for us to understand that actual sales place will take in such a period of time. Until such time, banks can give a bridging type of a loan to fund his business. So these side of things also will come, especially these customers who are into construction of apartments. Their repayment comes from asset liquidation. The assets are the condominium properties and the apartments what they have in their stock lot in the for sale item, which may be listed under fixed assets of one building, but part of which is available for sale. And then when they liquidate that, money will come into the mainstream of business. So asset liquidation also considered a kind of a repayment or payback. We are going to discuss in detail after the break of the risk involved in risk faced by the customers. Now this you have to understand, we are doing credit management part of it. Credit management is to evaluate a customer. Now customers will not pay the bank due to various risks they face, and these risks will close down their businesses, reduce their cash flows. So as a result, we will not get the repayment. So we are going to discuss that in very much detail after the break. Thereafter, we'll also going to discuss about the structure. Right? So I'll take a break right now, and then we'll. Yeah, I'm back. Can you see the slides?
Yes, sir.
Yes, sir. Yes, we see.
So we looked at the corporate credit analysis, evaluation of a corporate customer. We looked at purpose and the repayment, that is a payback. The third item on the four-step model is the risk. Here, when I say risk, it's the risk of the customer. Risk not coming to the bank because customer faces risk. When he faces risk, what happens is those risks will make him non-pay his repayment. So as a result, we will have a credit risk in the bank. So this risk we have also have four categories why why the corporate clients encounter risk. The first is financial risk. Now, mainly when you give a loan, it's a financial arrangement, and the financial risk occurred to a customer will really jeopardize his repayment. It also we do two kind of evaluation. So we do financial evaluation and qualitative evaluation. The financial risk is identified through financial evaluation, or we call it a quantitative analysis. And then rest of the risks, macro conditions, management and ownership, business risk, are qualitative factors where those things cannot be given in figures. As a result, we call them qualitative analysis, and we will analyze the risk involved in financial risk as well as qualitative risk before you deciding on the customer's facility. So I'm going to take the financial risk first, because this is the reason why I ask you whether you have done the um, ratio analysis under different lecture. If you have done, this will be a kind of a supplement, and because then I don't have to do into very much detail why we do this, but I will touch the basics of financial risk analysis, of looking at the customer's balance sheet and the P&L. So financial risk measures actually stability, flexibility, variety, and cost of company's funding structure to determine the value of advance, rate of interest, and also based on risk what collateral we going to take. So when customers ask for the facility, this financial analysis is very much needed to determine how much we are going to give him. And then also, based on risk, uh, comes out of this financial risk, we will determine the rate of interest, and also we will determine the security cover we need to take in case of the risk is higher than what we expected. So these are actually ratio analysis is done for these particular purposes to determine the value of advance, the rate of interest, and the collateral cover. So we looked at customers' liquidity, we look at customer solvency, we look at customers' funding strategy and what kind of instrument we will use him to fund. And then also we look at the efficiency of the company, then kind of a interest cover, at least whether he's making money to pay back. Then we also look at his overall profitability. Major items are actually liquidity. He need the customer should have. We were talking about cash flow profits. Banks are worried about money coming into the business rather than having book profits. So liquidity is an important factor for us to recover the facility what we grant. Solvency is the bankruptcy. We want the customers to be a going concern. That means he must be in business rather than close down his shop to pay back our facility. Then we also very much interested in profitability because loss-making companies finally they will eat into their equity, and then the customers' equity contribution is negative, and then it will fall into uh, non-payment. Similarly, the efficiency also very important. Companies should actually manage the assets and the cost to income ratios. If they can't manage the finances, eventually, despite having money, they will uh, lose profits based on mismanagement, and as a result, we will have financial risk arising from this customer, which will lead to non-payment of facilities what we grant. So these are the financial risks. I will run through some of the ratios quickly for you to give you a measure of liquidity. Liquidity means company's ability to convert current assets into cash to meet current liabilities as and when fall due. So you need to remember most of the companies will not keep cash. So the cash comes from realization of debtors. So they need to have a good debt recovery action in order to meet liabilities as and when fall due. So current ratio, what we looked at is we want to see how much current assets available to convert into cash against the how much liabilities we have to pay in cash. So if you have sufficient current assets for customers to convert into cash higher than current liabilities, we generally says that the company is in a position to repay the facilities what they have taken. So current assets generally in a company, I told you, they include uh, debtors and stocks. Current liabilities are the creditors what they have taken. These creditors include bank repayment also. So they should be able to convert their debtors uh, and stocks in order to pay the bank as well as their creditors. Current assets is total current assets divided by current liabilities will give you a current ratio. Now, uh, what kind of ratio you would like to have from a corporate client in order to qualify him to have sufficient liquidity to pay our facilities? Um, Generally, bankers prefer 2:1. That means um, twice the size of current assets in compared to their current liabilities. That means their stocks and debtors should have, we'll say 100 million, then their creditors should be around about 50 billion. So that way they should be able to pay back on conversion. They are comfortably enough to pay back their liabilities as and when they fall due. But however, if you see some of the companies in the corporate customers, they don't have this 2:1 ratio. Now 2:1 will generally be available for customers like who are in trading companies, because they have large stocks, they have large amount of debtors compared to their creditors. They are twice the size, so then it will make 2:1. I will take an example for you to show why it is not always like that. We'll take if you take Maliban biscuits as well as Munchie, those are in the same business background. They are manufacturing, they are trading. So that type of customers may have 2:1 ratio, because there is always large stocks available because they continue to manufacture, and also they sell on credit, so then they will have a credit balance, the debtors balance always. They use agents to sell, but agents also they provide credit, so that they have a debtors balance also. So this type of manufacturing and trading generally will have 2:1. Then we'll take example of what example I will take? Yeah, I will take example of SLT, Sri Lanka Telecom, and I also take one from the same industry. I'll take Dialog. All right. So they are in the same telecommunication business, like the Munchie and Maliban. If you see the balance sheets of both SLT and Dialog, you can see I did the analysis somewhere about 3 years ago. Dialog's current assets was 0.38 to 0.1 liabilities. 0.38 to 1 as liability. So 0.38 is their current assets. Their current liabilities stood at 1. So now SLT, their current assets took at 1.5 and their current liabilities stood at 1.2. Now both are in the same industry. Same industry, but two different current ratios they have. Now, when you say that this current ratio should not be thought of, on the basis of 2:1 always, that generally apply for manufacturing. From different industry to industry, it changes, and even on the same industry, depending on the business module, what they adapt, the current asset ratio also can change. Now you have to think Dialog in that particular year made about 3 times the profit of SLT. Having even low very liquidity level, their profitability was very high. Reason being is their business module. Because their current assets generally they sell either prepayment or they have very little postpaid packages. So what they do is they don't. It's a service provider, so they don't have any stocks. It's the debtors what happen. When you sell pre, you get money even before you provide the service. So it is not appearing as debtors, but it will go on to the other side into the creditors as prepayments. They have got money which belongs to customers, and they have to pay them or not to pay them, but they will deduct from once the service is provided. Whereas mainly SLT has post-paid packages. Therefore, they have already provided the service and they have billed them and appear in the debtors as a payment to be collected. So two different ratios will come into the same type of business, same industry, but the business modules are changed. So you see, we cannot apply a norm like 2:1 in all corporate customers. We have to think what business they are in, what business module they carry in order to determine. They are still um, a more profit-making company having less current assets, but they get suppliers credit or the credit is given by their own but they provide services in advance, so the money is already been collected and those monies also can be invested and make more money, so they are in a better position, so they don't have to borrow money from banks and their finance cost also uh, lesser than SLT. As a result, they make more profit uh, in the business. So same industry, different business module, also sometimes will have different liquidity ratio, current ratio based on business module, and as a result, profitability also are different. So I took two other things, but this business module you have to take into consideration in various type of industries. If you take supermarket, now Keels also will have about 0.4:1 level because they also the stocks what they have already got in their stores is not the stocks what they have paid for. So the, the credit sometimes same supplier may have to put 10 times before he gets the money on the first supply. So as a result, they have collected the money. Yeah, they have sold the money. All the items what they sell is either on credit card or cash. Credit card, the very next day they send the slips to the bank and get their money, and therefore there's no debtors. Whereas entire stock what is in there has been provided on credit, so they don't have to have a higher liquidity to be maintained to run the business. In fact, they don't need any liquidity because they completely manage with suppliers credit. As a result, you can see, they have the growth rate is very high because they set up branches everywhere based on those monies have not been borrowed from the bank, but based on their suppliers give credit, they use the those amount what they have sold and until settlement to do their growth activities. So those are different business modules available in the corporate clientele. Uh, your business module sometimes determine your profitability, and as a result, um, you will have higher profits. The quick ratio and the liquidity is actually you take on a trading customer. Current assets include debtors and stocks. The stocks we call it inventory, and you deduct from your total current assets the inventory and compare with your current liabilities, you will get the quick ratio. Now, on a trading customer, if you have got 2:1 current ratio, quick ratio may be 1:1 because you have removed the stock component out of their current assets. Therefore, quick ratio focuses more liquid assets. That means you have only debtors only, so you don't have to wait till stocks to be sold on credit and then those debtors to be paid. Whereas quick ratio will give only you recover your debtors and then those will become cash. So this is a Methodology, what's generally we see the liquidity of a company. And you have to remember on a trading or manufacturing customer, 2:1, banks are very happy. 1:1 on current ratio, 2:1 on 1:1 on quick ratio, and 2:1 current ratio. But different business modules and different industries they apply, and based on their requirement, this ratio may change from 2:1 to 0.38 to 1, 0.5 to 1, like that. So you need to remember that you cannot compare trading and manufacturing customers to other service providing customer. So you need to think about the industry. You need to think about the business model they apply in managing liquidity. Now I go to solvency. This is another important analysis you may have already done. We call it solvency, gearing, leverage. All these terms have been used for. So gearing ratio is generally banks look at their long-term liabilities. That means any facility, any creditor who have given money to a company, not to be settled in 1 year, but beyond 1 year. Then you compare with the shareholders' money, how much money shareholders have contributed. Then we arrive at a gearing ratio. Generally, this is important for us to identify whether shareholders have put sufficient funds in comparison to the long-term liabilities of the company. So what happened is to make a going concern, shareholders' contribution is a must on the long term. So that's why we compare this particular ratio, and especially we need this ratio for project financing. Project financing, we generally would like a contribution from customer along with our facilities to to do the project. If a customer brings a proposal to do a kind of a project, we will see the total project value, and we will see how much contribution come from customer. Generally, at least 25% of contribution we request from a customer who wants to do a project, and the bank will provide 75% of facility to do the project. And then also the project will be evaluated depending on the different methods, internal rate of return, or you can apply different type of project evaluation criterion methods to value the, we can have cash flow statement. We must have surplus cash at the duration of the project to arrive at viability of the project. And then this gearing is generally we prefer at least customer to bring 25% compared to the long-term liabilities the customer has taken either from banks or any other funding arrangements he has. So that's a solvency. Then we go into profits. This is also another important area for you to analyze, because without profits, customer is unable to repay, and especially banks is interested in cash flow profits. But where book entries also we need to examine in a financial analysis. We look at two kinds of profits from a customer, especially customer sells, and we want to see whether he sells at a margin. That means his cost of the product is much lesser than the sale value of that product. That's what we want to actually look at. So we look at gross profit based on the cost of the product and the sale price of that. So what we do is gross profit is arrive at, we take the total sales, Then we deduct cost of goods sold, and then we get the gross profit. Then gross profit divided by sales into 100 will give you a profit margin of the, we'll say he sells for 100 million and he makes, say 15 million, he buys for 85 million, then he has a 15 million gross profit. 15 divided by 100 into 100 will give 15% of gross profit. Similarly, after gross profit, in our profit and loss, we start deducting from the gross profit sales and administrative expenses, depreciation. Then we arrived at earnings before interest and tax. Then once we have paid the interest and the taxes, you get the net profit. So net profit margin is taken. Now say we'll take the same example. Now say we got gross profit 15. That means he sell for 100, bought for 85, and he has 15% gross. Then he sells his other expenses like sales and administration, depreciation, taxes, interest, all will say another 10. Then he will finally end up with 5. So his net profit is 5. Divide by 100 into 100 will give 5%. So this, I took example of gross profit and net profit. In between, you can also check the operating profit. That is before you pay your interest and taxes. Again, you can divide that by sales and into 100. You get the operating profit margin. These three margins what will indicate how profitable is his sales. That means he sells higher than what he purchased or higher than cost of producing those goods. But it is not only the profit of the company, but we have to see how profitable is the company. So we apply some other ratios to see in overall how the company is performing. We call it return on assets. We arrive at the net profit and we divide that with total assets. Right? We can either use net profit before interest and tax or interest before interest, also arrive at another ratio. But return on assets include net profit divided by total assets. Now, why we are doing this is to arrive at how profitable is the company. From the total assets, for his earnings, only some of the assets may be utilizing. So we want to see from each asset he input into the business, what kind of profits he make. Now this can be explained in this way. You will have current assets of stocks and debtors. You have fixed assets. You may have land, building. You will have machinery. You will have, some of these assets are not actually contributing to make money. Say, if he has 2 buildings, which only one can accommodate the entire total staff and still do the same business what he does, the other one is a idle asset. Now, idle assets are not helping the company to make money. Those idle assets, if they can make into cash, and that cash also can be used to manufacture more and sell, then he can make more return on assets than what he has. But it's not always the case, because what happened is some of the assets are also getting revalued over a period, even without having to utilize it. They're also getting, then you can add to revaluation reserves those. But ideally, you must use the assets required to run the business. Then rather than having in your balance sheet unutilized assets just to give a higher value to your asset base. Now, this is very quite evident in the example which I earlier explained, which is I said higher profits are earned by dialogue than SLT. You know, some of the assets SLT has, they have large buildings, large number of buildings all over the country. They have very big towers all over, which are actually showing in the balance sheet as assets. Whereas dialogue may use other kind of technology to do the transmission of their information or the providing telecommunication services. So they may not have the assets like the SLT has. SLT may have about 5 times the assets of um, dialogue. However, then the return on assets is much lesser than uh, dialogue because some of the assets are not being fully utilized to generate revenue. So as a result, company may not be very much in profitable. Maybe their sales are, but we need to analyze these two types of um, profitability ratios to see how profitable their sales, how profitable is the company. So in your lending evaluation, both are required. Sometimes in order to keep your shareholders happy, you also need to actually look into the return on equity, net profit compared to the shareholder equity. Shareholders generally would like to earn more dividends than what they can get from a fixed deposit in a bank. So return on equity also a very important factor to keep the shareholders in a particular company. So this is profitability. Then we also can have the efficiencies, you know, asset turnover ratio, debtors turnover ratio, inventory turnover ratio, creditors turnover ratio, and fixed asset utilization. These are some of the efficiencies. Now, to show this, I will take a, now you have a paper, you can write a circle, kind of a big circle. On top, you can write cash. Then I'll tell the rest of how the circle goes. On your right, on like clock turns is, you take not anti-clockwise, the clockwise, you put an arrow on this circle. Next is your cash, you buy raw materials. We'll say, I'm taking example for you to understand this efficiency ratio through a cash conversion cycle. We call this, I'm going to draw a cash conversion cycle for you, and you're going to do it for me. So we'll do this exercise together. You draw a circle. On top of the circle, you write cash. Now, that is the amount of money the shareholders have put in to start this particular company. Now, along the clockwise, you put arrow, and then halfway through where the if I say, if the clock, you have put the first cash on when 12 o'clock strikes, or then you go clockwise, and when you reach 3, that is, you have passed 3 hours. But generally, we have entire circle is 12 hours. So after, when you reach to 3 p.m., you have reached the quarter stage of the circle. There you write I'll call it raw materials. So you use this cash, or you write work in progress, because in between you have bought raw materials. Some are through credit, some are through using this cash. Then you have raw materials at the where the clock stops at 3. That is the quarter stage of the circle. You have work in progress. So in between, either side of the circle, you can write creditors, and then you write raw materials, RM. So you have bought raw materials, part using creditors, part using the shareholders' money, and then um, you arrived at work in progress of those raw materials. Then the raw materials will go through a manufacturing process in the next 3 hours. That means you pass 4, 5, 6. When you reach there, you have the finished goods, which is your stocks. So when the clock chimes at 6, you have converted those raw materials into finished goods, and now it's available for sale at that point. So you use part of your cash, creditors, bought raw material, and then you went through you arrived at the work in progress level. Then once your work progress level finishes, you have finished goods. We consider the finished goods have been sold on credit. So when the clock reach 9, from 6 to 9, that is the third quarter of your cycle, what you have is you have sold for credit, and then you have, that point, you have debtors. When the debtors, you convert from 9 to 12 when you come, you have convert them into cash, and then you have you get your cash back for what your investment is. We call this cash conversion cycle. That means efficiency depends on the fastest way you can convert your cash. That's how the efficiency is being judged. So how the debtors turnover, internet turnover, all depends, creditors turnover, all depending on how fast you can get your cash to buy raw materials, then pass the stage of um, work in progress, then you have your finished goods get into debtors into cash. The faster you get this cycle going, rather than having to have 1, 2, 3 to 12, the faster you do it, efficiency is your companies. So this is what we look at, but you can do the calculation based on the way I have given the ratios, but ratios will determine the period of what you're going to achieve. If the debtors are going to take 60 days, from 9 to 12, you will take 60 days. If you to acquire your raw materials make 30 days, the first quarter will take 30 days. Your manufacturing is also going to take 30 days. By the time you get your stock, you have already passed 2 months. And if you also take another 1 month to get your finished goods into debtors, then you have passed 3 months. Then debtors to realize another 2 months. So the whole cycle will take 5 months. 5 months is a long time, which for you to get your product out, manufacture and sell and get your cash. That time only you can pay the your banks, your creditors. So it's a very long time, and your efficiency, I would say, is at a minimum. If you can get this ratio in 10 days, that will be much faster. You provide 1 week credit, and the rest of the process will take another 3 days. Then you are faster, in your efficiency ratios are up. Then you are in a position to convert, get your cash back in 10 days. I know in a manufacturing company you can't do it in 10 days, but faster you get this cash conversion done, your company is more efficient. So that's how we look at the efficiency ratio. So those are the financial analysis. Now I must go into kind of a credit evaluation is done. Not only financial analysis, you also do qualitative analysis. We are corporate customers. We did SME analysis in a different way. We did retail analysis in a different way. Now these, some of the banks now they use credit rating module to decide the customer's facility. Most of the banks have internal rating modules. What they do is all the details what they are in their 3-year financial statements get input into your system called internal rating module, and they do the calculation of all these ratios by the computer itself, system itself, and then they throw out results. Based on these results, you can determine whether this person's facility can be given. Similarly, you can allocate certain marks like what we did in credit scoring for their qualitative factors, and then arrive at a total mark position, and then based on that you can decide the facility for a customer. So you can actually digitalize or computerize your entire evaluation process. Some of the things what people have created, the Moody's is actually credit rating agency. They use something called KMB Risk Calc, is the name of the program, and they will help the financial institutions to evaluate financial evaluation through this their system. So what they do is they looked at some of the ratios what we have already looked at in our ratio analysis. In that, if they say profitability ratios, if the profits are higher, they say default, lower the default probability. As long as your customer is making profit, is going to pay. That's a norm. Remember, it has to be cash flow profits. Leverage is about his solvency. Now, higher leverage increases. That means his borrowing increases compared to the contribution the company has made. Then his default ratio is going to go up, because bank is giving, we call this oversupply of credit compared to the equity contribution made by the bank. So sometimes we also insist on the customers, we will not increase the lending higher than 25%, 75 to 25 level. That means 3:1 debt equity ratio, because when you do that, what happens is our contributions are high, and if there's a loss, the higher losses will come to the bank rather than to the customer. So therefore, this leverage ratio also considers to check the probability of default. Growth. Now, growth is, you can have growth in your profit and loss, and also you can have growth in your balance sheet. Profit and loss growth is determined from the top line. We call it increase in sales. So if the company is continuously increase its sales, that means they are on the growth path. So similarly, your balance sheet's values are getting increased year on year. We also think the assets are increasing, and which is an indication of when sales grow and the assets grow, the chances of default is less. If the assets and the sales decline, that means the chances of default risk is high. Similarly, activity ratios is the efficiency ratios, and if your debt turnover ratio is high, that means you will have bad debts. If your stock turnover ratio is high, you will have stale inventory, or you will have outdated stocks. Similarly, your manufacturing process take longer time, you will have production problems. So these will actually, your cash conversion cycle will give you a complete picture of your activity ratios or your efficiency. Size of sales and total assets also different probability. We looked at growth, we'll also look at the size. So this kind of ratio analysis also will be helpful through a system. You input all those figures, their balance sheet and the P&L into a system, and then arrive at the growth and the they will throw out the ratio analysis, and then we'll be able to quickly decide the uh, facility based on the repayment and other efficiency ratios. We also would like to touch upon the qualitative aspects. I already spoke about the business model. Um, um, Business models sometimes give you a real advantage. Now we discuss about it. How um, Argils and these supermarkets are growing. They actually sometimes ask their suppliers that they to give about as much as 90 days credit. So when you have 90 days, if the item what they supplied will be sold in 10 days, that means he will have to do 9 suppliers in order to get the first supplier's cash. Whereas the company, the Cargills or the other supermarket chain has already sold 8 times and got their money of the value of that supply, and they can use that money because of the business model they use. Similarly, the strategies also we need to consider the competitive advantage your customer has over rest of the people, rest of the same industry. I think you may have done this analysis. We call it Michael Porter's theory of competitive advantage. In that, what they see is they put a circle in the middle, and they put your company's name in that middle, and also in the same circle you put their rivals or the competitors. So what the Michael Porter says, within that circle itself there is competition, and you need to rise above your um, peer groups or your same industry level in order to survive. But that is not enough. You also need to have competitive advantage in other areas because you will have the fear of newcomers. So he also, in his theory, he says newcomers to the industry also will take your business, not only the existing companies. So you sometimes the entry need to be blocked. Now say various companies adapt different methods. If the regulation is tough to start a business like banking, newcomers will be very less. But in this consumer goods, anybody can manufacture and enter into the industry. So what they do, they have different ways of blocking newcomers. Now it has happened in our part of the world. You can see when Cargill's, we had this Walls ice cream, which was actually started by Unilever, but it is actually a different product from what they generally do. Other fast-moving consumer goods. It's a manufacturing unit. We need refrigeration. We need place to sell, delivery channel, which Unilever lacks. So over a period, they found that operation is not really profit generating for them, and immediately Cargill snapped that, and now they have this magic ice cream, which was originally Walls ice cream. They didn't sell the brand name, but the equipment and the facilities of that industry was taken over by them. Similarly, they have acquired Kist, and now they have acquired Kotmale. So all those products which were competition to them. Now they have acquired those companies and now they are available in their stores in the same name, but both companies are owned by Cargill. So competitive advantage is actually you need to actually either block or buy over the newcomers. Then you have to satisfy your existing clientele. You also need to satisfy your suppliers. So fear of supplier leaving or fear of customer leaving you also need to be managed if you want to be strategically in business. So you provide various deals to your customers. You provide various other things for your suppliers. Like, I'll take the same example of Cargill's. Now, their agri business, they even provide kind of loans in order to buy seeds and various other things to farmers. So they keep their, suppliers in their umbrella rather than, the suppliers cannot getting into other place. So similarly, they provide various promotions to keep their customers with them, like discounted rates, credit card offers. All those are done to keep their customers. Then they also should have. Generally, you ask this question from any business by credit analyst: what is your USP? USP is unique selling proposition. What are you differ from your competitors? Because to be in business, you must have some differentiation from your customers, from your competitors, in order to excel above your competitors. So, if you ask this question from a bank, because we sell the same, I told you under strategic risk, we can't do much because we sell the same kind of product. We have to apply the same price because interest rates cannot be undercut from another bank. Main unique selling proposition of a bank is the service you provide, the way you provide customer service. Some may like digitalized service, some may like personal service. So banks will every day try and improve their customer satisfaction, and that is one day will become the unique selling proposition of any bank. So business strategy is also very important to remain in business. So you need to inquire what is the business strategy followed by your client as your qualitative analysis before you give credit to this customer. Then earning dynamics is actually something like your efficiency ratio. So you need to actually verify yourself by whether how long it will take to get your cash conversion cycle going. How do you manage your assets properly in order to create return on asset to the company? So this earning dynamics and asset management also another key business risk. Um, you need to maximize your profit with minimum cost. We call it cost to income ratio. So lower the cost to income ratio, your strategy is best compared to your competitors. So you need to actually manage your earnings, manage your assets properly in order to stay in business. And bankers need to see that they follow these strategies and create maximum value out of this to see their business risk. If they are not doing these things right, you can say these businesses have their own business risk. We'll see now the management and ownership. It's another type of a qualitative analysis we need to look at. We look at strategies under business risk. If the strategies are good, we consider the customer is good to lend. Strategy is itself not enough. We need to see who is actually creating those strategies, the management. We sometimes, if in a corporate custom evaluation, sometimes you need to ask those questions, what type of strategies you adapt, because those things are actually mentioned in the company profile. So apart from when you get your information, financial information through 3 years balance sheet, management account, age and your debtors, stock statements, you also need to ask your company profile. Company profile provide you the strategies, the type of product what they produce, what the strategies they apply to stay in business. Sometimes they also going to say that the systems what they follow, what type of risk management, what type of business processes they follow, how their information is coming to the top management from the bottom, and with the ideas that they can have new product developments, so on is very important. Similarly, you can go a little further and you can in fact ask your organizational chart. That's we call it corporate structure. In that we can identify individuals capabilities and how their board is consist of, whether the board consists of real professionals who can guide the business to profitability. Their reputation sometimes matters to be in business. So the management skill, you can ask who is your CEO, what qualification and experience he has. You can get hold of an annual report to see the more details of this company. So when you are information gathering, I would request, apart from 3 years financials, you can ask for company profile. In that, sometimes they will give the organization chart. You can ask for the annual report. These corporate customers actually they prepare annual report. In that, they will give you details, the skills of the management. They will give the qualifications, who is in that what place, and as a result, how the company has performed well. All that is mentioned in the annual report. So sometimes this information is required in your credit evaluation. Especially, you need not only financial evaluation, you also need to look at qualitative aspects of the company. Similarly, under qualitative, there's another factor called uh, macroeconomic risk, because these companies operate in the open market. We call it the economic environment is the marketplace. So if the marketplace gives them headache, those headaches finally end up in non-repayment of the facilities obtained by the bank. So like I can easily say now, here fluctuation of commodity prices. In the recent past, everything has gone up in price. Similarly, most of your customers, their raw materials also would have gone in price. As a result, they may have to increase the price of the final product. Once the final product price increases, I'm sure some of the sales may not be as usual before. So there can be drop in sales. So market risk will be there for your customers. Their commodity prices may increase, the interest rates you may increase depending on the base rate applied by the central bank. Then also, if they are to buy their products or import their products, the exchange rate also important. The current exchange rates are very high. At the same time, also they are unable to find foreign exchange required to do the importation of their raw materials. So these things actually present them with market risk. So macroeconomic conditions include market risk, the liquidity risk, strategic risk and environment risk, and the legal and regulatory trust. So mainly market risk represent in the economy will affect the business, and as a result, uh, this risk will result in non-payment of facilities. So we looked at two types of risk. One is financial risk. We also uh, did some analysis through ratio analysis, and I also talked about you can apply internal rating modules to evaluate your financial risk. Then we looked at qualitative risk, which will include the business risk, the strategic risk, and the macroeconomic risk, and the ownership risk, which also need to be managed in order to sustain the business and earn profit and then pay the money to the bank. So these are the risks faced by the customers to whom you have lent money or you are planning to lend money. So if these risks are very high, he's not going to make more money in order to repay the loan. So you have to actually analyze these risks, represent to customers, and you must see what strategies or what mitigation techniques the customer adapt to minimize these risks. And if the risks are high, those risks are going to affect your lending and you will face credit risk. To avoid that, sometimes you can use some mitigation techniques. So we are going to discuss those mitigation techniques, or you can mitigate risk through covenants, collateral, and price. Mitigate means to minimize or to sustain those risks. Because once the risks are minimized, you can make sure the customer will repay you as planned. Now, all these three words, covenants, collateral, price, can apply to your facility in order to minimize the risk arising from customer. So covenant is a pledge or promise between two parties to perform under contract. This contract can be a financial contract or non-financial covenant. So this covenant is a promise by the customer that they will not do a certain thing. I'll explain to you what is a covenant. Can be a financial or non-financial covenant. When you give a facility, we give the customer details of that facility by way of an offer letter. And you consider the customer to sign the offer letter and return the copy of that to you, which will be, or the original to you, which will be kept as a security document of the bank. In this letter, we put certain conditions, and those conditions are what you call covenants. Now, I'll take two examples. On a retail customer, now I think your bankers, you all have taken housing loans. In this housing loan, you get offer letter. In this offer letter, it says you have borrowed 1 million rupees at the rate of this much and repayable over next 10 years and at the rate of your installment. Apart from that, it says the asset has been mortgaged to the bank. That is, they will give the description of the property and the value of the house has been mortgaged to the bank. Then under that, they will say you accept to maintain the assets pledge under good state of repair. What do you mean by that? It is there in your offer letter you have given, but you have not read it. You have signed the offer letter and handed it to the bank. With that statement, what you agree is that you will keep your house in order. That means you will not remove certain items what has been there when the original valuation is there. You will not remove windows. You will not, keep that house in good maintenance. So the value will remain as at the time of your um, loan contracts being signed. Similarly, it can be another area that it will may restrict for you to, uh, take secondary mortgage against the same property. So that's another covenant. Then it also will say we also need to have a mortgage protection cover to give this facility. Now, mortgage protection cover is something like this. Bank has taken a mortgage over your property. Mortgage protection cover is an insurance policy favoring bank in case you fail to pay under this mortgage. Bank is not going to, sometimes it's difficult for them to execute karate execution, especially uh, under housing loan. Time to time, there will be restrictions coming from the government also to help the borrowers sometimes. So when those restrictions comes, you may not be able to, go to courts and dispose the security. So then when customer default on the mortgage, if you have an insurance cover, bank can actually claim mortgage protection cover, but the insurance premium has been paid by borrower, so that our risk can be minimized. So the covenants are sometimes used to really mitigate the risk of non-payment by the customer. The financial covenants I can also mention on a corporate customer. I told you debt equity ratio. Where project is concerned, we say debt equity ratio is 3:1. Then you can put a term and condition in the offer letter. Throughout this project, debt equity ratio should not increase more than 3:1. That means you restrict the customer to borrow more under the same project at a later date if you have given funding at 3:1. So only you may borrow for what you have already repaid. So with that, you make sure that customer will have sufficient funds to repay the loans. Collateral, I think you understand that much better than me, because collateral is the security what we provide. It can be an asset mortgage, it can be a cash margin by way of a fixed deposit, or it can come from a guarantee. So all these are kind of collaterals we produce as safety of our facilities to the bank. We call it a pound of flesh. You give everything to the bank, and sometimes still bank used to ask more collateral from you in order to give facilities. Now I want to ask small questions if somebody can answer. Do you know the difference between a collateral and a security? You give security to the bank, or you provide collateral to the bank to take a facility. Go a little much. I can give some more clues. We'll take the same example like what you got a housing loan, so you signed a mortgage over your house bank. That is the collateral. Is it a collateral or a security what you have provided? The mortgage what you provide to the bank under your housing loan uh, is a collateral or a security? If someone knows, you can answer. Because
Security.
yeah,
The
security.
security.
You're right, because generally, if the asset what you mortgage is owned by you and you have signed a mortgage over the asset and that was taken as a security that has taken as the cover for the facility, we call it a security. Like you would get a facility and then you ask someone else to provide a security for that, like third party fixed deposit or a corporate guarantee. We call them, those are collaterals. Similarly, mostly corporate customers, um, directors provide their asset as a cover for the facility for the company. Then what happened is we call them collateral. Directors jointly sign guarantees, those are going as collaterals. So you need to remember when you say collateral, it can be a security. If it is provided by the borrower himself and the asset is owned by the borrower, we call it a security. Anything else, we call it collateral. We also use price as a factor to, make our risk lesser. We call it risk mitigation technique. You know that mostly your credit card facilities are given on clean basis. And I want to ask what rate you apply. Most credit card facilities will carry about 18%. Whereas your housing loan, if you have taken from the bank under staff, you have given only 4%. Now that difference reflects the riskiness of the facility. So the riskiness can be reduced with the price. So when risk is high, what you do is you price the facility more. So with that, what you do is you recover most of the interest upfront through the high rate what you have charged. Whereas if you have given much more secure lending and you have applied a lower price for a long period, you are relying on complete repayment along with the interest rate agreed because your risk is minimized through providing that collateral. So remember, sometimes price also will help you to mitigate risk of non-payment. So I have listed out some of the financial covenants, which I already actually explained. Debt equity ratio, I said no increase in debt. Provision for financial data. So you over a time you say no leases can be arranged against the assets. No assets could be sold without the permission of the bank. So these are kind of a covenants you can put in your offer letter to make sure that repayment get regular. I think you will have a complete session of what securities bank take for facilities. So I'm not going to go into details one by one type of facility, the mortgages, the legal aspect of it, guarantees, the legal aspect of it, because you will learn that in this separate module, and that doesn't come under my purview of the syllabus to teach you credit risk. So collateral also need to be actually uh, collateral need to be located. If someone give you a property, ideally bank staff should have gone and seen along with the valuer the property to see whether the road access is there, whether inquiry from neighbors that there is actually sufficient value based on the valuation given by the valuer. So those things is that you need to locate and easy to value. These values should be going up rather than down, because especially where properties are concerned, the prices are going up. Also, you need to actually easy to realize. Now, if you're given against a fixed deposit, you don't have to worry much about stroke of a pen. You can uplift the deposit and cover your facility. But if you have taken a different collateral, like property, you may not be able to do that. You may have to go to courts, uh, apply parat execution, or apply the mortgage rights what you have under the security, and then file action. So those will take time. Then it is not that easy to realize. The factor will come in, and the longer you take, the more credit risk you are going to take, because longer these cases are going to go, one day judge will himself will decide that interest should have been stopped at the time the legal action was filed. So once again, I told you, credit risk is recovering your facility principal plus interest. So if interest is not being paid, once again, you are presented with credit risk. Pricing, I told you that we looked at pricing of your credit card and a mortgage loan. Um, Finally, uh, there's a type of facility which actually I need you to explain in detail about trade finance. And I think this explanation I will give you next time, because I may not be able to finish for about half an hour on this, because this is a very important area that you need to identify credit risk in specialized credit, because we give different type of facilities. We give overdrafts, we give term loans, we also fund uh, import-export trade. Then we apply different type of credit facility to them. They are short term, because these are very important credit areas for you to learn, because this will include import-export financing. We call it trade financing, and involve various type of facility types. So when I say about 4 boxes of in our lending evaluation, we looked at the purpose, we looked at repayment like payback, then we looked at risk. In specialized credit, there are some other risks also involved in this. Then the final one is structure. To teach you how to do the structure, I decided to took up a facility of trade finance. With that, you will understand structuring also. You can minimize your risk, because for a simple example, I'll take, if you're taking a housing loan, uh, if someone come and asks you, I want to buy a house, please give me an overdraft. As a banker, you may not agree, because that's not the right structure of the facility. That to housing loan, it need longer period of repayment, whereas overdraft is a facility repayable on demand. So if a customer asks you a overdraft to fund a housing purpose, you will refuse. Similarly, the structuring will sometimes reduce the risk of term. The shorter the term, you need to fund with different type of facility structure. That's why if a working capital is required, you give short-term loans and overdraft. Especially trade finance also kind of a short-term facilities, depending on the way customer terms of credit the customer has with their overseas buyer or seller. So we will study this next time in detail, and with that we will finish the credit management side. After I complete this, we will credit the management side of our process, because you see in our process, this is the process. We have studied how the customer comes, credit origination, then we did financial evaluation, we have done qualitative evaluation. Then your evaluation paper will go to credit risk management side. They also do evaluation in a different way, and they also do a recommend. Once that comes, what we need to do is actually approve the credit, then finalize the securities, and then disperse the facility. So that is the credit management side. So once I finish the specialized credit on trade finance, we will complete one side of our coin, the credit management. So I will devote next time to do the credit risk management proper, because you need to go there, you need to actually understand what you do in the business level, because in business level also you manage risk, and those risks are based on your information gathering, your evaluation method, your rating, applying rating module, then your ratio analysis, your qualitative analysis. Finally, you understand the structure for different type of facilities, then you manage your credit well. Thereafter, we can discuss about the credit risk management, what they do that in the risk management department where credit is concerned. Hope you understand so far. With this, I will conclude today's presentation. As we start, I will touch on this slide called specialized credit next time. With that, we will conclude the credit management. Thereafter, next session, I will devote credit risk management. If time permits, I will take a question from past paper and discuss you for you to get familiarized what type of questions will come on this particular section of the credit management diploma. Okay, if you have any questions, you can, if you can't personally present, the chat box is open. You can actually write. So next time I can prepare the answers and come. With that, our learning process will get, much more practical, because we are not seeing each other. Once you do that, you will understand the subject matter well. So thank you very much, and I'll see you next week, next Sunday at 8:30.